directeur.
prononcer sa déclaration
Governor Macklem
préliminaire
will make
et
an
ensuite
opening
on va
statement,
tourner
and
aux
following
questions des
that,
médias.
we will turn to
After his
media
opening
questions.
remarks, Governor
Après ces
Macklem and
remarques
Senior
liminaires,
Deputy
le
Governor
gouverneur et
Carolyn
la
Rogers will be happy
sous-gouverneur
to take your
seront
questions
ravis de répondre
until
à
about
vos questions
1:15.
jusqu'à
So, alors, Monsieur le
11h15.
Gouverneur, la parole est à vous.
Governor, you
Thank you, Paul, and good morning.
Merci,
I'm very
Paul.
pleased to be here
Bonjour.
with
Je suis
Senior
ravi
Deputy
d'être là
Governor
avec la
Carolyn
première
Rogers
sous-gouverneure
to
Carolyn
discuss
Rogers
today's
pour parler de
monetary
notre
policy
décision de
decision.
politique
Today, we
monétaire.
lowered the policy
Aujourd'hui, nous
interest
avons
rate
réduit
by
le taux
25
directeur de
basis
25 points
points
de
to
base pour le
2.5%.
faire passer à 2,5
Through the recent period of trade
Pendant la
upheaval,
récente
Governing
période de
Council has
bouleversements
been
commerciaux,
proceeding
le
carefully,
Conseil de direction a
paying
procédé avec
particular
prudence en
attention
portant
to the
une
risks
attention
and uncertainties
particulière aux
facing
risques
the
et aux
Canadian
incertitudes
economy.
pour l'économie canadienne.
Three developments
Depuis la
have
décision
shifted the balance of
de
risks
juillet,
since
trois
our
choses ont
July
changé
decision.
l'équilibre des risques.
First, Canada's
Premièrement,
labor
le marché du
market has
travail
softened
canadien s'est
further.
encore
Second,
assoupli.
although
Deuxièmement,
there are still some
même s'il
mixed
reste
signals,
des
on
signaux
balance, recent
contradictoires,
data
les
suggest
données
upward
récentes indiquent en
pressures on
général que les
underlying
pressions à la
inflation have
hausse
diminished.
sur l'inflation sous-jacente
And third,
ont diminué.
with the
Et
removal of
troisièmement,
most
comme le
retaliatory
Canada a
tariffs
levé
by
la plupart des
Canada,
droits de
there's
douane de rétorsion,
less
les risques à la
upside
hausse
risk to
entourant
future
l'inflation
inflation.
ont diminué.
Aujourd'hui, on a réduit le taux directeur de 25 points de base pour le faire passer à 2,5%. Pendant la récente période de bouleversements commerciaux, le Conseil de direction a procédé avec prudence, en portant une attention particulière aux risques et aux incertitudes pour l'économie canadienne. Depuis la décision de juillet, trois choses ont changé l'équilibre des risques. Premièrement, le marché du travail canadien s'est encore assoupli. Deuxièmement, même s'il reste des signaux contradictoires, les données récentes indiquent en général que les pressions à la hausse sur l'inflation
have diminished. And third, with the removal of most retaliatory tariffs by Canada, there is less upside risk to future inflation.
Remains. But with a weaker economy and less upside risk to inflation, Governing Council judged that a reduction in the policy rate was appropriate to better balance the risks going forward. The bank will continue to assess the risks, look over a shorter horizon than usual, and be ready to respond to new information. So let me provide some details on what we've seen since July. After remaining resilient to sharply higher U.S. tariffs, global growth is now showing signs of slowing. U.S. consumers are cautious and employment gains have slowed. U.S. inflation has picked up in recent months as businesses appear to be passing on some tariff costs to consumer prices. In China, GDP growth was resilient in the first half of the year, but appears to be softening as investment weakens. The Canadian economy is being affected by both U.S. tariffs and the unpredictability of U.S. trade policy. GDP declined 1.6% in the second quarter, largely as expected. Exports to the United States fell sharply, both as payback from the pull forward of activity in the first quarter and because tariffs are dampening U.S. demand. Tariffs are having a profound effect on several key sectors, including auto, steel, and aluminum industries. Chinese tariffs on canola, pork, and seafood, new U.S. tariffs on copper, and higher U.S. tariffs on softwood lumber will spread the direct impacts further. Uncertainty is also weighing on the economy. Business investment contracted in the second quarter. Many businesses have told us they have paused investment plans given elevated uncertainty about U.S. trade policy. Businesses are also concerned that demand in Canada will weaken as the economic fallout broadens. There are some signs of resilience. Consumption was stronger than expected in the second quarter, and housing activity increased. But in the months ahead, low population growth and weakness in the labor market will likely weigh on household spending. Employment has declined in the past 2 months, increasing the unemployment rate to 7.1%. In addition to significant job losses in sectors that rely on U.S. trade, employment growth in other parts of the economy has slowed as businesses have scaled back their hiring plans. Wage growth has continued to ease. Turning to inflation, CPI inflation was 1.9% in August, the same as at the time of the July monetary policy report. Excluding taxes, inflation was 2.4%. The preferred measures of core inflation have been around 3% in recent months, but on a monthly basis, the upward momentum seen earlier in the year has dissipated. A broader range of indicators, including alternative measures of core inflation and the distribution of price changes across CPI components, continue to suggest underlying inflation is running about 2.5%. The federal government's recent decision to remove most retaliatory tariffs on imported goods from the United States will mean less upward pressure on the prices of these goods going forward. Still, the disruptive effects of shifts in trade will add costs even as they weigh on economic activity. It is difficult to predict the extent of cost increases, where they're going to show up, and how they will get passed on to consumer prices. With some stability in U.S. tariffs in recent weeks, near-term uncertainty may have come down a little. But the focus is shifting to the upcoming review of the Canada-United States-Mexico agreement. And new U.S. threats to use tariffs as an instrument of geopolitical pressure are also contributing to global uncertainty. Lors de cette décision, le consensus était clair: réduire le taux directeur pour la première fois depuis mars. On va continuer d'évaluer les répercussions des droits de douane et de l'incertitude sur l'activité économique et l'inflation. Notre priorité est de préserver la confiance des Canadiennes et Canadiens dans la stabilité des prix pendant cette période de bouleversements mondiaux. On va soutenir la croissance économique en s'assurant que l'inflation reste bien maîtrisée. At this rate decision, there was a clear consensus to lower the policy rate for the first time since March. We will continue to assess the impacts of tariffs and uncertainty on economic activity and inflation. We're paying particularly close attention to a few things: how exports evolve given the impact of U.S. tariffs and changing trade relationships, how this spills over into business investment, employment, and household spending, how the cost effects of trade disruptions and reconfigured supply chains are passed on to consumer prices, and how inflation expectations evolve. We are focused on ensuring that Canadians continue to have confidence in price stability through this period of global upheaval. We will support economic growth while ensuring inflation remains well controlled. And with that, the Senior Deputy Governor and I will be very pleased to take your questions.
Okay, thank you, Governor. We will go to questions now. We'll start with the reporters who are here in Ottawa at the bank, and then we'll go to those who have joined us remotely. As usual, I'm going to ask people to please limit yourself to one question, and that way we can get to every media outlet and everyone will have a chance to participate. If I forget to do so, please state your name and affiliation. For those in the room, please press the button on the microphone in front of you to activate it. That way everyone will be able to hear the question, and then press it again to turn it off once you are done. Avant de poser vos questions, veuillez vous identifier si je ne l'ai pas encore fait. Et bien sûr, comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. Okay, so we'll get started here in the room, and I'm going to call first on Paul Vieira of the Wall Street Journal.
Good morning. Was there a lack of conviction among senior Bank of Canada policymakers that the easing in inflationary pressure is sustainable? And is that why your guidance today is rather cagey?
You're reading a lot into that, Paul. Look, there was a clear consensus to cut our policy rate by 25 basis points. As we have for the last couple of meetings, we considered two alternatives: hold the policy rate where we are, or cut the policy rate. I think, what tipped the balance really in favor of a cut this time was there was a clear sense that the balance of risk has shifted, and I outlined the main reasons for that. Labor market has softened further. On inflation, the inflation picture hasn't really changed a great deal since where we were last January. total CPI inflation came out yesterday, 1.9%, where it was in the data we had at July. CPI ex tax came out 2.4 yesterday. I think it was 2.5 in July. If you look at our core measures, they remain, or the preferred measures of core, trim and median, they remain around 3. I think if you look under the hood, though, what you can see is that, earlier in the year, we saw some upward momentum in those core measures. If you look at the more recent monthly readings on the core measures, that momentum has come off. Yes, if you look at the inflation data, there is some more comfort that some of those upward pressures we saw in underlying inflation are easing off. There's still some mixed signals there, and I indicated, we know tariffs are disrupting trade. We know businesses are looking for new suppliers. They're looking for new markets. That is bringing new costs. So, we're going to be watching those costs carefully and how those get passed through. So, I think, the guidance really is we're not as forward-looking. We're not being as forward-looking as normal, and we're paying close attention to the risks and uncertainties. We demonstrated today, if those shifts, we're prepared to take action.
All right, I'll ask Kevin Carmichael from The Logic next, please.
The communication today, besides any explicit guidance, is any mention of fiscal policy. There's clearly a lot coming down the track. Could you elaborate on how you're thinking about it? Surely it must have come up at the meetings, the deliberations over the past week.
So on fiscal policy, there have been a number of announcements of targeted support to the most affected, to the directly affected sectors, the sectors that are facing new tariffs. There have also more recently been announcements on some big projects. From our perspective, we will, as those plans become more concrete, we will be assessing their macroeconomic impact. Yesterday, the Minister of Finance announced the budget will be tabled on November 4th. We'll certainly be looking at that closely. I mean, from our macro perspective, it's less about individual measures and more about how everything fits together, what the overall macro impact is. And certainly once we have the budget, we will be assessing the implications of the government's plans on the economic outlook, what that means for growth, for inflation, and ultimately for what we need to do with interest rates.
Okay, Greg Quinn from Market News, please.
Good morning to you both. You are cutting interest rates, as you say, with core inflation at 3%, the top of your band. You're also looking at wider measures, and you say that those are 2.5%. Given how upset Canadians were when inflation jumped after the pandemic, aren't you taking some kind of a risk here with inflation pressures?
Well, Greg, I do want to underline that, as you said, Canadians remain concerned about the cost of living. And our primary mandate is to maintain low, stable inflation, and we are very focused on that. I mean, total inflation is 1.9%. It's been running slightly below 2 since April, largely as a result of the elimination of the consumer carbon tax. If you look at, yes, trim and median are running around 3%. As I indicated in response to Paul's question, if you look at the more recent monthly readings, they're running around, if you look at like the 3-month moving average, it's about 2.5%. And if you look at a range of other core measures, you look at like traditional exclusion measures, CPI-X food and energy, CPI-X, they're sort of 2.4, 2.6. If you look at the percentage of components of the CPI that are rising faster than 3, it's roughly about where it is when inflation's around 2.5%. So when we look at it, we see underlying, headline inflation is 1.9, underlying's running about 2.5. Some of that upward momentum we saw has eased off. So yes, we do need to consider where inflation is going. At this point, inflationary pressures look a little more contained, and against that background and the background of a weakening economy that will put additional downward pressure on inflation, that tipped the balance of risks in favor of cutting our policy rate today. But we are proceeding carefully. We are going to be balancing those risks, and we don't want Canadians to have to worry about big increases in the cost of living.
Next, I have Mark Rendell from the Globe and Mail, please.
What would you need to see on the inflation front and on, I guess, the economic and employment front to cut again this fall?
Well, Mark, if there was just one thing, the job would be so easy. I think you got to look at everything together. Obviously, tariffs are weakening the Canadian economy. You can see that very acutely in the directly affected sectors and sectors, for example, transportation and related services that are supporting those trade sectors. And you've seen employment, you've seen quite a bit of job losses in those sectors. One thing that has changed since July, when we looked in July, what you saw is that in the rest of the economy, employment was still growing. Employment growth in the rest of the economy has now slowed. We will certainly be looking very closely at what are the spillovers from weaker exports to the rest of the economy, and that that is going to be an important factor going forward. The weaker the economy, obviously, the more downward pressure that puts on inflation. The other side of it, though, is certainly when you talk to businesses, they're telling us they're facing a host of new costs related to trade disruption. They're trying to change their supply chains, they're finding new suppliers, they're trying to develop new markets, they're trying to reroute things. That all entails cost, and when you step back, the reality is tariffs are increasing trade friction with our biggest trading partner. That has efficiency costs. Monetary policy can't undo that. It can't reverse that. What we can do is help the economy adjust while maintaining well-controlled inflation. That's what we're focused on. To get more specifically to your question, it's going to be about balancing those risks. We've demonstrated today, if the risks tilt, if the risks shift, we're prepared to take action. And if the risks tilt further, we're prepared to take more action. But we're going to take it one meeting at a time. We are taking a shorter horizon. We're being a little less forward-looking than usual. And we'll make that risk assessment in October when we get there.
Okay, Promit Mukherjee from Thomson Reuters, please.
Good morning, Governor. Governor, the federal budget, as you also said, will be just after a week of your October's rate decision. Would you rather just wait in October and take a decision in December whether to cut or not, considering that we'll only after the budget will be clear how much of fiscal stimulus is coming, how much of cost-cutting measures are coming?
Well, if if the budget was the only thing happening in the world, that might make sense. But I expect there's going to be, we're going to get a lot of new information between now and then. And I've highlighted a number of things we're looking at. We're particularly focused on what's going to happen to exports. We saw a very sharp drop in exports in the second quarter. Part of that was just undoing the pull forward that we saw in the first quarter. Part of that is less U.S. demand for our exports because there's tariffs. The other thing we've seen on the export side is we've seen some increase in our exports to other markets. So going forward, we're going to be watching very closely, where do exports go from here? As I mentioned, how does that spill over into the rest of the economy? Where do those additional costs go that businesses are facing with the disruption of trade, and what happens to expected inflation? So those are the key things we're going to be watching, and we'll be looking at the balance of risks carefully as we come into October. Fiscal policy, I expect between now and the next decision, we will get some more information. As I said, for us, seeing it all put together in the budget is important because that gives you the kind of overall macro perspective.
Okay, I'm going to call for the final time on Randy Thantong-Knight from Bloomberg News. Randy.
Hi, Governor. There are two parts to my question. So the first part is, recently there have been continued strains in funding markets. Will the Bank of Canada consider a technical adjustment to the deposit rates again, similar to how you did in March? And the second part is, can you explain what's happening with Quora and liquidity in overnight repos?
Yeah, there's been a number of things going on in the overnight markets, Randy. I mean, the primary one, the thing that's had sort of the most direct effect, is we had a big maturity early in September, big bond maturity. And so there was a step down in the amount of liquidity in the markets. That's put a bit of strain. I think the markets are still digesting that step down and adjusting. We also, you'll recall in our financial stability report in May, we talked about a greater presence of foreign hedge funds in the market. They fund on the repo market. They fund Government of Canada securities on the basis trade. That trade goes, there's a bigger demand for that trade when there's an expected move in policy rates, as there has been in the last few weeks. So there's more than one thing affecting overnight markets. We've got a variety of tools that we can use. We're not contemplating any change in the deposit rate right now. Our plan, I think I answered this question last time, our plan to normalize our balance sheet is still on track. It's the same as we've shared consistently all along. We do expect some of this turbulence as we get down to our steady state settlement balances, but we've got a variety of tools we can use before looking at the deposit rate.
All right, next I'm going to call on Jordan Gowling from the Financial Post, please.
Hi, Governor. Where are we in terms of cost increases brought on by trade disruption? Are Canadian businesses still holding on to those costs or passing them on? And how much of a concern is that for policymakers when we're talking about the risks to the inflation outlook?
Well, I'll answer that in two parts. I mean, the first part, what we've actually seen in the data that we have. So what we've seen in the data that we have is, as I mentioned, inflation hasn't changed much since where we were in July. If you look under the hood, the monthly data suggests some of the pressures on corn, upward pressures that you see in core inflation in particular, have eased off. With respect to Canada's counter tariffs, you can see, you have to look pretty hard, but you can see some effects of those counter tariffs on the prices of some goods. You see it mostly more clearly in food. Food's perishable, so it gets passed on fairly quickly. Canada has now dropped most of those counter tariffs. So, going forward, what that means is, you'd expect those prices to come back down. I think, from our perspective, from a monetary policy perspective, I guess what I would underline is that, the effects of counter tariffs, the direct effect is a once-off increase in the prices of those goods. That'll show up as higher inflation temporarily, but to the extent that it's just a once-off level increase, the impact on inflation would be temporary. So we would tend to look through that. But, the risk for us is that a temporary increase, the increase in those prices has knock-on effects to other prices, and then it starts to look like ongoing inflation. I mean, from our perspective now, the fact that the direct effect of the counter tariffs has been removed, that takes away the first round effect, so there won't be a second round effect. So from our perspective, looking forward, that has taken off some of the upside risk to future inflation, and that was one of the things that tilted the risks today in favor of cutting the interest rate.
All right, next I'll ask Mackenzie Gray from Global, please.
Hi there. Further to the counter tariff conversation, can you outline how large a factor that was in the rate cut today? And as well, there still are some counter tariffs on things like steel products. Do you view that as a potential inflation risk going forward?
Well, I want to underline that, we're looking both at the inflation data we have and the future. And, as I just responded, the inflation data we have, what you see is that inflation has not changed very much since July. And if you look at some of the more monthly indicators, some of that upward momentum we were seeing earlier in the year has fallen off. So that's telling us that the risk that inflation is going to move up further has gone down. The removal of the counter tariffs reinforced that because, as I just mentioned, it takes some upside risk off future inflation. So those two things together are telling us that the upside on inflation is looking more contained, and with an economy that's weaker, that all tilted the balance in favor of cutting today. So I think you gotta look at how these things sort of fit together and reinforce each other. It's not one thing; it's a combination of things.
Okay, I've got two or three more here in the room before we go to the phones. Mike Lockacher, CTV.
Governor, thank you very much for taking our questions. In a post on X, Ontario Premier Doug Ford responded to your decision today by saying, "Good, now keep going." I want to get your reaction not only to that, but also to ask you about how live the discussion was by Governing Council for an even deeper cut than you did today.
Well, look, on the first point, we take our decisions independently of the political process. They are evidence-based decisions that will continue. End of story. On the second point, we did discuss two options, but as I indicated, there was a clear consensus across the Governing Council that the balance of risks had tilted in favor of reducing the policy interest rate, and I think I've outlined the reasons why we got there.
Okay, Colin Daiichi Mishima from Nikkei, please.
Hi, good morning, governors. Looking ahead, if the Canadian economy fails to recover even as rate cuts continue, is there a possibility that the Bank of Canada might implement quantitative easing? Would Trump tariffs qualify as the kind of exceptional circumstances that would justify QE?
Well, look, we're a long way from even contemplating that. We've got considerable room with our policy rate. I think what I would emphasize is if you go back to where we were in July, we published three scenarios for the Canadian economy. In one based on current tariffs, another one with an escalation of tariffs, and another with a de-escalation. If you take the current tariff scenario, which is roughly the tariff scenario we're still in, we're not expecting a recession. Growth was clearly negative in the second quarter. We are expecting growth, somewhere around 1% in the second half of the year. So that is slow growth. It's not going to feel good. It is growth, but it's slow growth because growth is. The Canadian economy is adjusting to a different relationship with its biggest trading partner. In the escalation scenario, where there's a significant escalation of tariffs, U.S. tariffs, in that scenario, the Canadian economy does go into recession, and certainly the situation would be worse. Having said that, I still think we'd be a long way from quantitative easing, and obviously in the de-escalation scenario, things would look better, growth would be stronger, you'd get more of a recovery.
Okay, before I go to the phones, I just want to check with CP. Yeah. Okay, Craig Lord, please, from Canadian Press.
Thank you, governors, for taking our questions. At this point, with the budget coming in November, you will make the majority of your decisions without a federal budget in place this year. How much of the uncertainty you're grappling with is tied to the U.S. trade policy, and how much is tied to fiscal policy?
I think I've said almost everything I can say on fiscal policy, so I can ask the senior deputy governor to say something.
I'm not sure what I can add. I mean, the governor's previous answer on fiscal was clear. I mean, it's one of the things we consider. It's not the only thing. There's a lot going on in the economy right now. There's a lot of uncertainty. We'll have the budget in November. We'll have another decision before the end of the year. We'll have some time to digest the budget, and it'll we'll be able to give you a sense of how we've assessed it, probably on our last decision in the year.
The only thing I would add is that tariffs, particularly the way the U.S. has implemented them, the tariffs in place in the Canadian economy are applied to very specific sectors: steel, automobiles, aluminum. You got Chinese tariffs on canola, pork, and seafood. You've now got higher U.S. tariffs on softwood lumber, tariffs on copper. For the rest of the economy, for other sectors, actually, tariffs remain very low, providing your business is compliant with CUSMA. So the impacts are very concentrated in these sectors that have been hit and the services that are servicing those. Monetary policy is a blunt instrument. We can help the overall economy adjust, but we can't target individual sectors. Fiscal policy really is a much better instrument for that. And there have been a number of targeted measures to support those sectors. And then, there's sort of a broader industrial strategy or a broader strategy, or how are we going to adjust to the reality that we're going to have a very different trading relationship with our biggest partner? How do we grow our internal market? How do we, get goods overseas? Those things are gonna play out over longer periods. But it's all those things. So we will be looking at the what fiscal policy. What fiscal policy is doing. We'll take that into account as we take our decisions. As I said, the most monetary policy can't undo the effects of tariffs. The most it can do is try to help the economy adjust at a macro level while keeping inflation well controlled.
Okay, I've got 3 reporters on the line. You've all done this before, but I'll just remind you to come off mute only to ask your question, then go back on mute as soon as you're done. That way everyone can hear the response. Let's start with John McFarlane from Yahoo Finance Canada, please.
Hi there. Thanks so much for taking our questions. You've said the bank is watching developments over a shorter horizon than usual. And there was talk as rates were being increased a few years ago that changes can take a year or more to work through the economy. So I want to know how you're thinking about lag effects in the present context, given that trade shocks seem to be having fairly immediate effects.
Well, you're right. Monetary policy still works with a lag. That hasn't changed. So yes, we do need to factor that in. I mean, the lagged effects of the cuts we've done over the last year, those we have a pretty good handle on. There's, as Milton Friedman famously said, there's long and variable lags. So, there's always some uncertainty. But before we got hit with tariffs, we could see lower interest rates were feeding through the economy. Growth was picking up. The unemployment rate was ticking down. Then, come February, we're hit with a series of tariff threats, tariff reversals, and we've seen the consequences of that. I will stress that, yes, we have shortened our horizon. That makes sense in a situation of greater unpredictability. That doesn't mean we're not looking forward at all. We, as I highlighted in another question, we're using scenarios as a way to map out the implications of different tariff policies in the U.S. What would the implications be for the Canadian economy? So we're using the scenarios to map out what different futures could look like, and those have been very helpful in our decision making because we're trying to take decisions that would be robust to more than one outcome. Looking forward, we have seen more stability in U.S. tariffs since July. And in that sense, at least, some of the near-term kind of general tariff uncertainty has declined. As I mentioned, outside of the affected sectors, tariffs remain low. If that stability remains, I expect we will be able to get back to a base case projection in October. We'll see. Certainly something could happen to throw us off that plan, but let's hope this stability continues and there's enough predictability that we can revert back to a baseline forecast.
Okay, next I've got Rob McClister from Mortgage Logic News, please.
Good morning. History has shown that inflation can significantly exceed the 2% target for a while, despite slowing growth. Are there any foreseeable current or upcoming factors that could potentially boost the risk of at least modest stagflation? And if so, what are they and how much of a threat are they?
Well, as the governor just outlined, I think we continue to think through a number of different scenarios. I mean, we've had a number of questions here today. We have seen a bit more stability in the tariff policy. That could change. We could see new tariffs come on. We could see changes in policy that aren't maybe even directly related to the Canada-US relationship, but are broader. That could translate into some renewed inflation pressure. We talked about the indirect effects. I mean, even in an environment where we're not seeing direct effects of tariffs on prices, we are hearing consistently from businesses that they're putting a lot of effort into protecting themselves against an unpredictable trade policy environment. So they're rerouting supply chains, they're looking for new markets, all of those things. You can't see it as directly as a tariff price change, but they do result in general pressure on prices. We've talked about fiscal policy. We'll wait to see what that brings. So there's a number of risks out there, which is exactly why we're being cautious. We're shortening the horizon that we look over when we make our decisions, and making use of alternatives like scenarios and stuff to think through how these different outcomes could affect both inflation and growth.
And our final question is from Anna Pereira of the Toronto Star.
Hi, good morning. Can you hear me okay?
Yes, go ahead.
So, Governor, you mentioned in your opening remarks that low population growth will weigh on household spending. How else does the central bank see that impacting the current weakness in the economy? And are you worried at all that it could prolong the contraction already caused by the trade war?
Well, what I would emphasize is that, population growth adds to both demand and supply in the economy. So yes, lower population growth means there's less new consumers in the economy. So, you're going to see less growth in consumer spending. It also means that there's less new workers in the economy, so there's less new people looking for jobs in the economy. Other things equal, that should mean the unemployment rate wouldn't go up as much as it otherwise would have. So, and basically over longer periods of time, these demand and supply effects are balanced out. We've been through some big swings in population growth in recent years, coming out of as the economy reopened in post-pandemic. There was a big surge in population growth in Canada, and what did that do? Well, yes, it added, the labor market was overheated. It added some workers. It also put more pressure on the housing market, boosted consumption. We're now seeing the other side of that. I think, from our perspective, the message is, historically, population growth has evolved pretty smoothly. And so we have sort of certain rules of thumb about, what potential growth can be, how many new workers you would expect to be added to the labor market every month. We need to adjust those rules of thumb to the reality that population growth is lower. So, the number of jobs that the labor market needs to create every month to keep up with new entrants is lower than it's been historically. The amount of extra growth you're going to get in consumption by adding new people to the economy is going to be lower than it's been historically. So we tend to report numbers aggregate, but it is useful in that setting to look at consumption both in total and in per capita terms. Obviously, for each individual person, it's more per capita that matters. For the whole economy, though, total also matters. So you need to look at both of them.
And that will do it for today's press conference. Thank you, Governor, Senior Deputy Governor. Thank you all for joining us. À la prochaine.